Let me hope you're seeing the question paper. And we are going to tackle, this is December. This is December 2021. And we are going to handle question 2. On the required part, we are told to evaluate the suitability of the planned investment using covariance analysis. Then number 2, we are to use the correlation analysis. Then part B, we are to compute the company's cost of equity using capital asset pricing model. And we discuss the model's underlying assumptions. So you have 25 marks here. So how can you approach this question? It was a bit easy, this one. Actually, it was a bit direct. Just that here you need to be a bit fast as you do the number. So we are told that WEL is a private company engaged in the production of furniture. The company has a debt to equity ratio of 5:2. Debt to equity ratio. So it means that here, the company is both debt and equity financed. Then we are told that WEL is considering diversification, of its business by investing in manufacturing of stationery products whose market appears to have a lot of untapped potential. The new investment will require, that is a new investment, it will require a total of shillings 500 million, which will be raised using debt and equity, within the existing capital structure. Our corporation tax is 30%, and corporate debt, which is assumed to be risk-free, is 13% per annum. Okay. We have the information. The information below has been compiled to guide management in assessing a planned project. We have the state of the economy. We have the corresponding probability, the returns for WEL, that is the company. Then we have the returns where the company is going, that is stationary. Remember, the company initially it was engaged in the production of furniture, but they want to diversify and start manufacturing what? Stationary products. And these are the returns for the stationary products. Take note that where you have a percentage, or actually with these figures can be in shillings. Okay, but here we are dealing with the percentage. You have the return on the market. Okay, we are told that the finance director has requested you to analyze the financial securities above, and you advise accordingly. So how do you start? How do you start with this one? How do you start? Okay, so what we are going to do, let me hope you're seeing my workbook. We are going to say let the first let W be, let W represent, you are looking at a portfolio. When you are analyzing, this is portfolio analysis. Covariance. Covariance is applied when you're looking at more than one investment. You have to, at least you must have more than one investment to apply covariance. So you need a portfolio, and your portfolio will be equal to the existing. This is S W plus what? W plus S. That is your portfolio. Like you are going to, you're looking at a portfolio, the investment number one, that is initially the company was investing in production of furniture. Okay, production of furniture, and now is diversifying to manufacturing stationary products. So that those two make your portfolio. So as you do this, of course, you need to know the return and risk. The return and risk for what? For investment in production of furniture. That is the company. Here you're looking at W. This is, remember W, you're looking at production of, initially the company was producing furniture. So you are going to make a table. We are dealing with W. So you need the return for W. Okay, that is this, and we have in percentage, we have 16. You can put the percentage in a bracket. Okay, you have 16, you have 12, you have 17, then you have 21. Then once you put your return, you will need to indicate, you need the expected return. How do you get the expected return? You get your probability. This is expected return. But how do you get expected return? You get the probability times the return from your investment. That is RW. Okay. Then here you will be just multiplying. You get the probability. Times 16. Okay. Remember, you need to budget your booklet as you're doing this number. You need to budget your booklet. Let's first include all what we need. So, what is your expected return? Multiply. This is 0.25 times 16. You get what? You get 4. You guys, I don't know whether you have the calculator with you. 0.25 times 16, I get 4. Remember, whatever you're getting is in a percentage. Whatever you're getting is in a percentage. Whatever you're getting is in whatever you're getting. You can even put all figures in percentage. All figures in percentage. Okay, so here you get 0.15 times 12, you get 1.2. 1.8. Then next is 0.2 times the 17, you get 3.4. Then next 0.4 times 21, you get 8.4. Then the total mean will be, the total mean you sum up. You add everything and get total mean. The total mean. The total here will be, when you add, what do you get? You guys, we should do this together so that we time ourselves. So that is our mean. So once you have your mean, to get the deviation, you will simply be subtracting. You get the return. This is 16 minus 17.6. Minus 17.6. 16 minus 17.6. Don't remove that answer. The answer is negative 1.6. When you have that answer, go ahead and click on squared, because you will be having the answer on your calculator. Now square it. Then after squaring it, multiply by the probability 0.25, so that you work concurrently. So here it will be 0.64. Then next, that's how you will manage time. When the answer is still on your calculator, press squared, then times the probability. But also always look at the required part. Why do you need variance? You need variance because in the question, you have the correlation. Roman 2, you need to use that variance somewhere. You have the correlation. You cannot use correlation analysis. Correlation analysis, obviously, you're going to use correlation coefficient. So for you to use correlation coefficient, you need standard deviation. You cannot get standard deviation when you don't have variance. That's why we are putting it. But in a scenario where you're dealing with a question where it is only requiring to get the covariance, then you don't need this column. If it is only a covariance, you just stop here. Because covariance, you simply get the probability times the deviation of the first investment, then times the deviation of the second investment. Okay. So next here is 12 minus 17.6. And the answer is negative 5.6. When the answer is still on my calculator, I square it, then times the corresponding probability, 0.15. So here you will have 4.7004. This will be 4.704. Then next is what? You can round off to 2 decimal points or to 1 decimal point, depending on what you want. Here I'm rounding off to 3 decimal points. Okay. So here it will be 17 minus, I'm getting the deviation here. The next is 17 minus 17.6, which is negative 0. This is negative 0.6%. Then next, it will be when the when the answer is still on my calculator, negative 0.6 squared is that, then times the probability 0.2, and you get 0.0772. Then next, you will get 21 minus 17.6. You get 3.4. When your answer is there, square it times the probability 0.4. here you get 4.624. When you add this column, what do you get? When you add that column, what do you get?
$10.03.
I have 10.04. That's what I have to me. That's what I have. Okay, so this is your variance. This is your variance. You can go ahead and get the standard deviation. You can go ahead and get the standard deviation. How do you get the standard? How do you get the standard deviation? Standard deviation. Standard deviation, which is always like sigma. Standard deviation, which is always sigma. I think I recorded it somewhere. Standard deviation, which is sigma, is root variance. Is root what? Is root variance. Remember, standard deviation is the same as risk. So take square root of this figure. What do you get? When you take square root of 10.04, what do you get? What do you get when you take square root of that? 10.04, what do you get? On your calculator, root answer. I have 3 point what? 3.168. 169. That's what I have as my standard deviation. I do the same for the other investment. Because here you have the return for the first investment, you have also the risk for your investment. I do the same for the other investment. Okay, I do the same. But this is investment in manufacturing of what? In manufacturing of stationary products, products. Okay. It is the same table, but we are going to change some figures. We are going to change some figures. Okay, these ones are wrong. We remove them. We remove the figures. Then where there is W, you put S. Where there is W, we put S, because we define that. Sorry for the delay. Here we put S. Put S. Put S. Okay. Then here also we put, where there is W, I put S. Okay, so what are the returns? What are the returns? From the, tell me very fast. You have the question? Now the returns are given in the question. The returns for the stationary, you have 17, 14, 18, and 23. 17, here it's 17, 14, 17, 14, 18 and 23, eh?
Yes.
18 and 23. So when you multiply, what do you get? When you multiply 0.25 times 17, that is 4.25. Then this is 0.4 times 0.23. I have here 0.092. Then what do you have here? 2.2 times 18, I have 3.6. What do you have here? 4.5 times 14. Okay, so when you add, what do you get?
Let me see.
Pardon? You guys can hear me?
But when I multiply 0.4 times 23, I don't get 0.092.
0.4 times 23. You get you get what? 9.2. 9.2. So when you add,
Yes, 9.2. When I add, I get 19.15. 19.15.
19.15. Any deviation, we get 17 minus 19.15. That is negative 2.15. Then I square that times the probability 0.25. Then here you will have 1.156. You can round off 3 decimal points. Then next 14, that is 14 this one, minus the mean 19.15. I get negative 5.15. I square it, then times the probability. I get 3.978. Then next 18 minus 19.15. I get negative 1.15. I square it times 0.2. Do you have 0.265?
Yeah.
Then next is 23 minus 19.15. I have 3.85. I square it times 0.14. I get 5.929. So the total is what? The variance. When you add, what do you get? What do you get when you add? Do you have 11.32? 328? Someone confirm?
Abby,
Yes, please.
it's 11.328.
11.328. That's what I have. Then when you take square root of that, that is 3.3.
3.66.
367. So when you round off 3 decimal points, you get that. Okay. So once you have this, it can be easier for you. It can be easier for you to get what? It can be easier for you to get part A. Part A of the part A Roman 1. Part A Roman 1. You need using covariance analysis. Remember covariance of a portfolio covariance. Take note that covariance of a portfolio will be always equal to the probability times the deviation of the first investment. That is this, the deviation of the first investment. Then times times the deviation of the second investment times this. Okay, that's how you get the covariance. Okay, so it means that I need to create another table, and then you copy the figures. You copy the figures, deviations, deviation. You have the figures here. You put them here. Then the same applies to the second one. When you're using the computer or laptop, it becomes very fast, but then here the last one is you put the covariance, which is this one. The covariance is this. The covariance is this one. So you simply multiply. You simply multiply. So you multiply. You simply multiply. Get the probability times this times this. What do you get? Let me start from down for you. Be doing the
0.86.
0.86. Remember, whatever we are
86.
doing, all figures in percentage. All figures in a percentage. Here, what do you get?
4.326. 326.
326. Then here
0.138.
138. Then next
5.236.
236. All right. So the total covariance, the total covariance is
10.56.
10.56. So that is your total, and it is positive, negative, positive. It is positive. What does that one mean? The conclusion. Remember, they said you do what? They said you evaluate the suitability of the planned investment using the covariance. So we have the covariance. You need to comment. You need to comment. If you find that you have a negative covariance, it means that those two projects do not move in the same direction. When we say in the same direction, what do we mean? If the profits are increasing in the project one, even in the other project, profits are increasing. If you're making losses in in one project, even you're making losses in another project. So you are moving in the same direction. If there is a decrease in the profit, also the other side there is a decrease in the profit. Same direction. But in a scenario where you have negative covariance, it means that if one project is making some losses, then the losses you're making in one project can be compensated with the profits from another project. There it is recommended that you invest in such, because they are not affected. The two projects are not affected by the same risk factors, or they are not moving in the same direction. At least when you make a loss in one project, that loss can be compensated by the gain you make from the other investment or the other project. So that is covariance. Please, covariance, when you're in an exam and you see they have just asked you covariance only, you don't need to create this column, the variance column. The variance column is used when we are answering Roman 2. Roman 2, the correlation analysis. And how do you use the correlation analysis? Now this one, what you're going to do, Roman 2, Roman 2, that is using correlation analysis, In short, here you will need for correlation analysis. You must use the correlation coefficient. For you to use correlation analysis, you simply use the correlation coefficient. And what is your correlation coefficient? It's R. It's the other. You know, it can be, so it will be like this. The correlation coefficient. The correlation coefficient is equal to. Who can remind us the formula? The formula is covariance over what? This will be covariance
over
over
X or standard deviation of Y.
Covariance
It is covariance
of W and S. Then everything divided by
standard deviation of S and standard deviation of W.
Standard deviation of S. Then times the standard deviation. Standard deviation of. Anyway, let me use it, avoid. But the formula is always given in an exam. But it is good to know that formula. This is the standard deviation of S times the standard deviation. Times standard deviation. This is W and S. Okay. So substitute. Do you have everything? Substitute. What is our covariance? Our covariance is 10.56. Then divide by what is our standard deviation for W? That was our first figure. That is 3. The standard deviation is this one. The standard deviation is this. Then times what? Times the standard deviation of S. Standard deviation of S is this one. What do you get? What is the calculator? You can do this directly. Simply get 10.56 divided by open bracket. What do you get? 10.56 divided by open bracket 3.168 times 3.367. Do you have 0.99?
Yes.
That's our, remember correlation coefficient. Correlation coefficient must be in decimal points. Must be in a decimal point. What does this one mean? What does this one mean? Remember what I said last time? When you're dealing with the covariance, you don't know the degree of relationship. Here with covariance, it helps you to know the relationship, whether there is a positive or negative, whether two projects move in the same direction or not. But the correlation coefficient tells you to what extent is that relationship strong, is that relationship weak, is it moderate, is it average? Okay, so when you're looking at correlation coefficient, you are looking at the what? The degree, the strength of the relationship. Okay, so it means that here, when the percentage is below 0.5, that is weak. That is weak. Then above 5, Above 5, depending above 5, you can say, I will normally say from 8, from 8 to 1, that is strong. Then between, but when you are an exam and you're confused, anything above 5, there at least you can even use the word strong. Anything above 5. But as you comment here, you will say that if it's negative correlation, then you advise the company to invest in that proposed investment. Okay. Then part B, they are telling us compute WEL's cost of equity using capital asset pricing model, and discuss the underlying assumption. This question was really a bit, I don't know why some of our colleagues were saying I do this number. Okay, here cost of it was a bit direct. Cost of capital for this company using CAPM, capital asset pricing model. How do you do this? Of course, the cost of equity, that is KE. KE using CAPM, KE is equal to what? KE is equal to RF, plus what? Plus beta, RF plus
Beta into
plus beta,
open.
just a minute, plus beta into, and this is beta, then times what? Times RM, isn't it? RM
Minus RF.
RM minus RF. Minus RF. All right, that's what you need. That's what you need. So the question is, do you have everything to help you to get cost of capital? In the question, you have RF. In the question, you have RF. What is RF from the question? When you check the question, RF is given. The risk-free rate of return. The risk-free rate of return. It is given somewhere. We are given a risk-free, which is 13%. Okay, that is 13%. 13%. Are you given the RM? Are you given RM?
Yes.
RM is
Return
what?
to the market.
RM is what?
But
That is
here it
return on the
confused.
market. This is it's return. Return on the market. Return on the market. But we can get, isn't it?
Yeah, we can.
Because when you see what we are given, it's not given direct, but you have this. You have
We
this.
multiply by the probabilities and then we get the summation.
Yes. So here you will just simply create a table, or you can even do on the face. You do on the face, but maybe for presentation purposes. Let me just, for presentation purposes, let me just create this. Here I put expected return, expected return on market, the market. Yeah, here we remove this. What was this? Is the return RM? This is M, but we need the expected return. What was the first figure? Now, Now,
21.
colleagues, because you need beta, because you need beta, you need beta, because you need beta, you will need to go ahead and also look at it. You need to go ahead and, because for you to get this beta, you get the covariance. Let me just also write, to get this beta, because you're not given this beta. So how will you get this beta? The asset beta. This is the, sorry colleagues. Here when you use E, this is equity beta, yet we are looking for, when you look at the question, you are looking for what? You are looking for the cost of equity, okay, using CAPM. So it means that there you will need the beta from the question. It can be, it always be given in the, okay, the formula is normally given. The formula is normally given down in the question. When you check, maybe I can open one of the past paper question, but it is always given. The beta is the what? From those with, they normally call it, when you check in your, they normally call it security beta. Security beta. In the formula sheet, do you see something like security beta? The formula sheet. There is beta of a security. That's what you use. That's what you use. Beta of a security. Okay, that's what you would use. And this is the covariance of the asset, the covariance of the asset you're talking about, and the return on the market. Then over what you see down is the covariance, because this is sigma squared of the return on market. This is variance. What the denominator is variance. So you get covariance of your asset and the market. Then over the variance of the market. Or you can use this second formula. This second formula you see, RRM, RGM. This is basically the correlation coefficient. The correlation coefficient times the standard deviation. The standard deviation of the asset. Then everything divided by the standard deviation of the market. So you can use two formulas depending on which one is easier for you. But in an exam like this one, for this specific question, the first formula would be better. It doesn't take time. This one would be better. But you saw when we were handling that question, the previous question, we used the second formula. Why did we use the second formula? Because we were given the correlation coefficient. The correlation coefficient of the asset and market. Then this sigma you see here is the standard deviation of the market, or rather of the asset, the standard deviation of the asset. Then this one, the denominator is standard deviation of the market. Okay. All right, so you can substitute. Here you don't have. I had those things. I don't know whether you recorded them. Just a minute. Don't know whether you recorded those formulas somewhere. Okay, you didn't record them. Okay, so here you will simply look at the covariance of the asset, then times the covariance of the asset and the market, then everything you divide by the standard deviation, sorry, everything you divide by the variance, the variance. If sigma is squared, that is variance, the variance of the market. This is market. This is market. How can I call it? This is market. Okay. I don't know what I can. This is market. Just understand that down this one you're dealing with the market. With the market. Sorry for the delay, but you know these things are not even easy to handle when you're using the computer. Okay, so it means that as you draw this table, because you need beta, you need to add the deviation, the column for deviation. It would be better you add the column for deviation, and that will be the RM. This is your RM minus the mean. Let me just copy this, minus the mean. Minus the mean. Here where there is S, I put M. Then because you need variance, I also create another column for the variance. I create another column. This is the variance. This is variance. Remember, variance is like this. Okay, this is your variance. Direct, what you have here is variance, which is equal to what? Which is equal to P into what? Into time P into the deviation squared. This is deviation squared. You square your deviation. Okay, so that's what you're supposed to do for part B. So you simply substitute. What was our return on the market? The first one is 21, 16, then 20, then another 20. Let me hope I'm copying the right figures from the question. Are you seeing the question paper? I am picking this. These are written on the market. I'm picking this 21, 16, 20, 20. Are you seeing the question?
Yeah, we are seeing.
Okay, so you can multiply and tell me the answers. Multiply and tell me the answers. So the first one is 5. 5. Is it 5?
0.2.
5.2. Then next, let me do the last one. 0.4 times 20. That is 8. The last one is 8. Then here it's what? This one is 4.
4.
Pardon?
2.4.
2.4. Then the total?
I have 19.65.
19.65. So let's get deviation. 21 minus 19.65. 21 minus 19.65. I have 1.35. I square it, then times the probability 0.25. I will be in a position to get 0.455. Okay, then next 16 minus mean 19.65. The answer I have negative 3.65. I square it, then times the probability 0.15. I have 9.99998. Okay, then here I get 20 minus 19.65. That is 0.35 square it
Five.
times the probability 0.2. Here you get 0.02.
Two.
0.25. Okay, then here it is 0.35 because when you get 20 minus this, you get I square it, 0.3 squared times the probability 0.4. So I have 0.049. When you sum, what will be your total variance? What will be your total variance? Add everything. Add everything. Others, are you following? Are you following what we are doing? This is 2.528. That's what I have. You can confirm. Do we have different figure? Do we have a different figure?
That's what I'm having as well.
You look at what you need, the return on market now. This is the expected return on market. It is this one. It's this one. It's this 1%. It's this one. Okay, that is your RM. Let's put here the deviation of the company. We have that. The deviation of the company is this. Then you also put the deviation of the market. What is deviation of the market? It's this one. You have this. Put this one here. Then you will be in a position to get the covariance by multiplying. Okay. So the covariance, you get your P, then times this deviation, then times this. Substitute and tell me the answer. So I can copy here. You have everything. I have everything. I copy. Let me hope I am copying the right things. Then the one for the market, it's this. For the market, it's this. So multiply and tell me the answer. Simply multiply probability times negative 1.6 times 1.35.
Negative 0.54.
Negative, this is negative.
0.54.
0.54. Then here, 54. Then here, is it my network? Here you have I have positive 3,066. That's what you have? So add and
Yes,
tell me
that's
the
what we
total.
have.
Add and tell me the total. Remember, we are looking for beta. That's why we are doing this, so that we can get beta of the security, or what we call security. The right way is this beta of the security. That's how they define this beta of the security. Okay. What is the total? We are using the phone. We can be using the
I bet that one on recovery is a negative.
Which one?
The 0.042. The deviation for well, the 0.6. I remember as if it was supposed to be a negative. First check and see.
Okay. This was a negative, because remember my data, I lost my data. So this was a negative. You get 17. Yeah, it is 17 minus 17.6. You get negative 0.6. Yeah, it's negative. It's negative even. So it means that even here it's negative. You guys, okay. But you gave me the right answer. Okay. Okay, when you add, what do you get? You add, what do you get? Negative 0.54 plus 3.066 plus negative 0.042 plus 0.476. You have 2.996?
Yes, positive 2.96.
That is positive. So that is your covariance. That is your covariance. Substitute and get the beta. So my beta will be covariance, which is 2.96. This is percent. Divided by the variance. Sigma squared is variance. And you have the variance of the market. The variance is here. 5. That is 2.5. Divided by 2.5. 2.5 at 2.5 to 80%. What do you get? Of course, on your calculators, you divide, don't put the percentage. It will be 2.96 divided by 2.528. And my answer is 1.171. So that is my beta. So we have everything we can substitute in our. Yes, please.
That part of the covariance, I think I didn't get. If you could kindly repeat.
The covariance.
From the formula, yes.
What is confusing?
What do those from the formula part? What do those over the curve the meanings?
Okay, here we define the W to represent our WEL. Remember in the question you have the returns for WEL. You see that, eh? So may I define the W to represent WEL. That is investment. That is investment in production of, because they were in this. WEL is this. Where say Enterprises Limited. Okay, so I defined it. When you look at the start, when you look at our start, we define those things. At the start, where is it? We define those here. You see this? We define it there. We define it. Then after defining, it means that the return RW is written for WEL. Then RS is the return for stationary manufacturing project. You get, those ones should not confuse you. Then this one stands for deviation. And where do you get deviation? It's from this table. You have the deviation. First of all, you start with probability times the return in the question. These ones are given in the question. Then you get the expected return because you need the mean. You need RM. This will be your RM. Yes. No. I mean other things. Okay. Here. This will be what you're doing here is going to help you to get RM because in a question you're given returns on the market. This is return on the market. But for you to get RM, the overall RM, for you to get the overall RM, you need to aggregate, get this probability times this probability times this. Now that you can be in a position to get RM, that is return on the market, this one. And this is where we picked return on the market. Then the deviation, how we are getting deviation. You get the return on the market, 21. Then you subtract mean, the total, 19.65. You will be in a position to get this. Okay. Once you get that answer, square it. Because here you have RM minus RM bar. So you square it. You square it. After squaring it, so when your answer is still on your calculator, you square it, then times the probability. You can be in a position to get it. Someone had asked, is it clear how we are getting these things?
Yes, it is clear, but my major problem was on the part of the security. That is called covariance, AM stroke S squared, those ones.
This is not S squared, it is sigma. Okay. Standard, this is variance. Look at this as variance. This is like variance. The whole of this is variance. Where are we picking it from? From the question. You see that examiner normally gives you that. Let me show you. Examiner normally gives you that. Are you seeing this number 2? Formula number 2?
Yeah.
Beta of a security. That's the formula we use. The covariance of the asset. And then, so here A will be, because now you're dealing with WEL. So where there is A, you will put W. Where there is A, you put W. So what you have down is variance. The overall, everything you have down is variance. Or you can use the second formula, this one. But this one, of course, you need to do another working to get correlation coefficient. RGM is correlation coefficient. This one. Correlation coefficient between W and M. Then this sigma is the standard deviation of the asset. In this case,
so now, okay, now if you look at the numerator, could I be right if I said the covariance of W times the covariance of S?
It is covariance. The down one. It is covariance. The first one is covariance of two of your portfolio, that is the asset and the market. Then over, just say over variance of the market. What you have down is variance of the market. You get? Someone who are we?
Yeah, I'm getting.
What we have down is variance of the market. This one down is variance of the market. But here you need to pay attention in the question, because sometimes the examiner can specify. The examiner can say, you determine the cost of equity, but they specify maybe to where you are going. Just here it was general. WEL's cost of equity. So you base on W. You base on W. So when you substitute, what do you get? What do you get? What will be your answer? What will be our K? Time is going. This weekend, I don't want to do other things. You know, the football. There are some matches. RF is what? RF is RF. What was our RF?
13%.
That is 13%. Then plus the beta is 1.17 times RM. RM we have 19.65. Then minus RF at 13%. So the overall answer, what do you get?
$20.78.
That's 20.78. All right, so that is your answer. That is your answer. Okay, and the assumptions of CAPM, you know them. You read, please, these assumptions of CAPM. Do you know them? You need to read, because there you have 13 marks. Now, when they ask you assumptions, now you don't know, you miss out. Assumptions, you may say, no, here you, as you use CAPM, you assume that there is no transaction costs, all information is available to all investors. That is assumption. You assume that all investors have what? The same information. You assume that there is no taxation. Those are assumptions. You assume that investors are rational and risk averse. That is also assumption. In a way that when you're risk averse, your aim is to simply minimize risks and maximize return. That's okay. Also, another assumption could be these investors are risky. Are price takers. You have to follow what is in the market. Here, prices are determined entirely by the overall market forces of demand and supply. So you are not the one who direct the market. You just follow the price that is reflected in the market. You cannot influence the market price of the asset. Okay, that is, investors are risk takers. That is another assumption here. What else? You need to put like 5 or 4, depending. Because here you don't know calculation takes how many, then theory takes how many. So you need to list all you know. There is also investors can lend and borrow unlimited amounts of risk-free interest rate. Okay, we have limited time. Try to read the theory until the save us. Okay, so that's all, guys. That's all. December 2024. this topic was in section A and section B. This portfolio your analysis, it was section A and section B, December 2024. And yeah, no examiners. And in each question, we are dealing with three investments, three projects. Here you have kings, bishops, and queens. Those are three projects. Those are three projects. These are three proposed investments: kings, bishops, and queens. And the examiner was asking, you advise on the appropriate portfolio of investments to undertake using covariance theory. So here you need the covariance of portfolio 1, you need the covariance of portfolio 2, you need covariance of portfolio 3. So it means that you need to create portfolios. How do you create portfolios? Someone who had asked, are you on?
Yes, I am.
So you need to create portfolios. Like a portfolio must have 2 investments. So you will have to create a portfolio 1 for kings and bishops. That is number 1. That is portfolio number 1. Then portfolio number 2, you create the one for kings and queens. That is portfolio number 2. Then portfolio number 3, you create what? Bishops and queens. That will be your portfolio number 3. Then for each portfolio, you determine the covariance for each portfolio. Like the same process, table like this. You create a table like this to help you to you create a table like this. It is here. A table like this to help you to determine covariance for each portfolio. So you will have like 3 tables in this form. 3 tables, which takes time, right? Here you need to manage time. It takes time. Can you hear me? I see network is on and off. Can you hear me?
Yes, we can.
So it means that in that question, you create the portfolio 1, you have this table. You need this table to get the covariance for that first portfolio. You also need another table in this kind of form to get the covariance for second portfolio. Then you do the same, the third portfolio, to get the covariance. Then at the end, of course, as you advise the best or the appropriate portfolio, because here they said you advise on the appropriate portfolio of the investments. So the appropriate portfolio will be that portfolio with a negative covariance. Okay, if you have 2, then all of you recommend the management or the board to go with those portfolios where you have negatives. But if you realize that you don't have a portfolio with negative covariance, then you advise the board not to undertake that kind of portfolio. That was part B. So this one, you really need to be very, very fast. Remember, there is APV also, which requires time. You see section B, still section B question 2, it had also portfolio analysis with 3 projects still. And they were asking you to use the correlation coefficient. You cannot determine correlation coefficient without covariance. So still you needed to determine covariance. After knowing the covariance, you divide by the what? Now you need the covariance for 3 projects. For 3 projects, Arabic and Robusta, Arabic and the extras. You create portfolios. 3. They must be 3 portfolios. Okay, so you look for correlation coefficient for each portfolio. Then at the end, you choose the one that is best. Remember, the one that has a negative correlation coefficient is the one you recommend. The one that has a negative correlation coefficient, because there it means that those two investments in that portfolio do not move in the same direction. Okay, or the loss the loss you may incur in another project can be compensated by the gains you get from another project. Then using portfolio theory. Now, using portfolio theory, here, assuming investors of KUL are risk takers. So in this scenario, when you're using the portfolio theory and they give you this statement, so it means that you can use the mean variance analysis there to comment. You will need the mean of a portfolio. You will need also the risk of a portfolio or the standard deviation of a portfolio. Remember, we talked about all those things last time. Here, how you get the mean of a portfolio. This is how you get the mean of a portfolio. This is how you get the mean of a portfolio here. This is how you get a mean of portfolio. Then this is how you get the risk of a portfolio or the standard deviation of a portfolio. They give you the formula. The formula is here. It's given in the question. Maybe if they supply that and they don't include. If they supply and they don't include, but the formula is given here. The two asset portfolio standard deviation is this. But remember, I gave you shortcut. In a scenario where you have the covariance, then you don't need to use, maybe to those who missed that session, you need to go ahead and listen to the recording. You need where you have RAB, then RAB is the correlation coefficient. Correlation coefficient, maybe because you have that, you can simply use it. Then this W is the proportion. W is the proportion. So you have the how much did you invest in investment? How much did you invest in? If they don't give you that, then you assume that it is on equal basis. You assume that it is on equal basis. So to those who missed the first session about this, when you look at December 2024, that's where I was talking about Black-Scholes model. They simply asked the theory, not calculation. I think examiner is trying to test us, trying to take us this side. So you may see this was section B. You can put this thing in section A. Discuss any four input variables applicable to the Black-Scholes model. The validity of using Black-Scholes model in pricing share options. The validity you're looking at the merits and demerits. That's enough. Maybe try to read more. But I believe we will pass. Don't fear. We will pass. We will pass. But I predict our paper also to be heavy. Like time, the way we manage. Things may be easy, but time. Time. Just imagine they give you business evaluation, they give you ratio, they give you portfolio analysis. They give you a project to do with the Black-Scholes model where you have to first get NPV before looking at the expansion. Okay. Okay, colleagues, let's see. Let's stop here. I have to do other things. Let me stop here. But to read, all we need is 50 for sure. All we need is 50 just to pass the paper and we move on. We need only 50. So let's try. It's not easy. It's not easy. Yeah, it's not easy, but let's try to give all our best. Let's try to give all our best. On Monday, when I get time, I will highlight on black scores model because most are asking. Okay. Okay. But read through this paper of December 2020. Black scores model thing. Okay. Okay. Okay, colleagues, let's meet next time. Any question? Any question? Oh, no, I just assume you know things of capital budgeting, how to determine working capital, fixed costs, those things. Because if they put black scores mode as question 1, still they fix those things. As I said, the discussing of black scores model has been common in ACCA papers. And remember, it's just, they just try to check here and here. So you never know. They can pick the idea ACCA is using and they put those things in our question. So have a nice evening, guys. A nice evening.
Okay, thank you, Abby.